Well, welcome everyone, and thank you so much for joining us today for a session of Economic Consequences of COVID-19, the Fed's Perspective, with Professors Frank Warnock and Kinda Acham. I'm Jonathan England, Darden Class of 2006, Managing Director at JP Morgan. I will be your host for today's session on behalf of Darden's Office of Engagement. Before we get started, I'd like to first say that we hope that you and your family are doing well. We are living through challenging times, and we hope that each of you will continue to take great care of yourself and your loved ones, as nothing is more important than your health and safety. Joining Frank and Kinda in this virtual classroom is special for me. I was lucky to be a Darden student in 2004 and 2005 when Frank joined the Darden faculty, and I was part of Frank's first class. I should say the lessons learned then continue to serve me well. Over the next hour, Professors Kinda Acham and Frank Warnock, Darden's resident Federal Reserve experts, will discuss the Fed's monetary policy and financial stability responses to the economic impacts created by the coronavirus pandemic. When you combine the steps taken by Congress and the Federal Reserve, the national response to the coronavirus pandemic represents more than a quarter of US GDP. The Federal Reserve is probably doing more to prop up the economy, but its contributions can be harder to measure. The Fed has launched a variety of credit facilities designed to alleviate pressure in credit markets. The scope and pace of policy easing so far has been unprecedented. Frank and Kinda will start with a few prepared remarks before leading a Q&A session. With that, I'd like to introduce Kinda Acham, Associate Professor in Darden's Global Economics and Markets area. She is a faculty research fellow in the National Bureau of Economic Research's Monetary Economics Group, and has served as a consultant at the New York Fed. Kinda joined Darden in 2018. Frank Warnock is in the Economics and Markets area, a research associate in the National Bureau of Economic Research, International Finance and Macro Group, and a consultant at the Fed's Board of Governors. Now I'll turn it over to Frank and Kinda.
So thank you, Jonathan. I will get started and talk for a few minutes, and then Kinda will have some comments as well, and then we'll go to Q&A. So first, wonderful to see so many participants, and I really look forward to being able to do this in person in the near future. So I'll start first with a quick story that will get at some of the underlying shocks. I'm going to give kind of a macro overview before Kinda gets into some of the Fed stuff. 5 weeks ago today, actually, I co-led a session in New Zealand with the chief economist of the Reserve Bank of New Zealand. And for that session, at that time, so this was March 10th, just 5 weeks ago, we could with a lot of confidence, we could point to the shocks, right? So we had a public health crisis in China that created a supply shock, think supply chain disruptions. We had a demand shock in some sectors, with some sectors shutting down pretty quickly, think hospitality and travel. And we had layered on top of that an oil price war between Saudi Arabia and Russia that led to a fall in the price of oil by 50% in a matter of days. All those things, if you put them together, would have been painful enough, right? If it just stopped there. And that last part with the oil price shock in the past, the U.S. economy might have welcomed something like that, but now we are the biggest oil producer in the world, and so that supply shock will lead to a lot of defaults in the U.S. Shale industry in particular. So that was all going to be difficult enough. That was 5 weeks ago. Fast forward to today, it's clear that at the center is a public health crisis, a global public health crisis. And that's the way that we have to think about this. If you go to the macro numbers that you guys have been seeing and will see, they've been stunning. They're going to continue to be stunning. I would caution one thing. I glanced at a headline today that was, something about retail sales falling, record drop. That's by design in part, right? And so we'll get to that. So I wouldn't get too alarmed by the numbers, but they will be stunning. China was first into this and might be the first out. So it's instructive to quickly look at the path from a macro perspective that China has taken. If we go back to the end of January, JP Morgan, and I bring up JP Morgan on this just not to single them out, but because I really respect their chief China economist, Haibin Zhu. At the end of January, he was forecasting Chinese economic growth year over year at 5.6%, seemed to be reasonable. In 6 weeks, he marked that down to negative 10% year over year, and in part because retail sales were plummeting by 20%, investment was plummeting. So just a really, really quick ceasing of economic activity. And this is playing out around the world. Just the Bank of Canada just announced yesterday that they expect in Canada from the end of 2019 to the end of June this year, they expect real GDP to fall by 30% total. We haven't seen numbers like this since the Great Depression. It's playing out around the world. The IMF just, I think yesterday, marked down their global growth forecast for GDP by over 6%. So they were thinking about 3% global growth in 2020. At the end of January, they were thinking that, and now they have it as negative 3%, which would be a global recession. You can go through commodity markets. Demand is plummeting faster than we've seen almost ever. In the US, the numbers again will be stunning. The employment numbers already are. US GDP estimates, if you think about how people are forecasting the estimates, it's starting with what sectors had to shut down and how important are they in the economy, and then you build up your forecast from there, and that's one way. But the second thing is, go back, it's a public health crisis, and so how we're going to get through this really depends on the public health aspect of it. And so people are actually having to write down what exactly their forecast is of how this is going to play out in the public health space. That then determines the GDP forecast. Right now, you're looking at a forecast ranging from something like negative 5% for the year to negative 7% and even more. But let's keep in mind the nature of the crisis. I think that's useful. It's a public health emergency. We all know that now. That means that it's different than past crises that we've been through. It's different than the savings and loan crisis from the 80s. It's different from the global financial sector crisis. It's different from these financial crises where the financial system or the banking system started the crisis. This is a public health emergency. That means that it's going to be, from a macro perspective, it's going to look like a cash flow crisis. Businesses are going to be cash flow impaired. Households are going to be cash flow impaired. And so that means that the response should really be about supporting cash flows. Most of that should fall to the fiscal authorities. We're going to talk about the Fed's response, but for the most part, this should be a fiscal response to stave off this cash flow crisis. So with the public health crisis, we have to support the public health response. You have to support jobs, incomes, businesses, cash flows, and that should be the way that we're thinking about this crisis. I'm not going to touch much in my prepared remarks on the Fed or banks, but I will just state, relative to the last crisis, to the GFC, the banks are in strong position to help through this crisis. The final thing I'll say with my prepared remarks, and I want you to remember this one, I want you to remember everything, but definitely this one, don't equate quarterly real GDP numbers with economic health, right? So if we think about economic health, often we look past the near-term numbers. We think about things on a longer perspective. If you think about the health of the economy, about the health of the people, it's much bigger than any real GDP number. The public health response is to shut down portions of the economy, to limit, to increase physical distancing. If that's the public health response, then you should expect to see stunning numbers in the declines in GDP. That shouldn't be taken as a weakness. It's by design so that we're stronger going forward. So keep a longer term perspective as you're looking at things. So I'll wrap up for now with that and turn it over to Kinda.
All right, so thank you, Frank, and thank you, Jonathan, for agreeing to moderate. I'm going to pick up a little bit where Frank left off, and I really do want to echo that point and maybe put it even more starkly because it sort of puts a lot of what the Fed is doing into perspective. So I think it's important that we characterize this downturn as a medically induced coma. And then the Fed's response to that is to provide life support. Why is that important? I think that it's important to sort of calibrate our expectations on what success is going to look like. So what does the Fed succeeding in its response look like? Now, to be clear, what economists mean by like the economic version of a medically induced coma, that's physical distancing, that's shelter in place. These are things that are sort of inherently contractionary, but from the public health perspective, there's no other choice. So two of our colleagues in the econ department very recently, so Anton Kornek and Zach Bethune very recently kind of tried to estimate what are the social costs of an additional infection. And they're putting that number at about $290,000 per additional infection. And perhaps even more importantly, that's 3 times what any individual agent would estimate. So kind of without a massive intervention, you're never going to get the level of social distancing and sheltering in place that the medical community deems essential to dealing with sort of the infectious nature of this virus. All right, so that's the world that we live in. We must shut down the economy if we want to give public health officials a fighting chance at this. What sort of support can the Fed provide? It's really the only thing that the Fed can do, which is print money. Now, it's within that framework, it's important to distinguish between printing money in normal times and printing money in a crisis. So in normal times, the Fed funds rate is a sufficient statistic for the actions of the Fed. So the Fed will print money or remove money from the Fed funds market, and that's going to cascade out to the more general economy through financial markets. In a crisis, be it financial or otherwise, so either a crisis that starts in financial markets, which was 2008, or a crisis which doesn't start in financial markets, but to which financial markets respond, markets seize up. And so you don't get much, if any, of that cascade. And so then what the Fed has to do is stabilize those markets and in the process kind of substitute for them, so substitute for the normal functioning that they would provide, which for us means that we have to look well beyond the Fed funds rate to see just how large the scope for Fed intervention is. Now, the overarching goal of all of these interventions is to sort of, to Frank's point that, this is kind of a cash flow crisis, is to keep the flow of funds going. So to keep money flowing through the usual channels so that those channels and businesses that are dependent on those channels don't die out before we reopen. I mean, that is kind of the economic equivalent of life support. Now, how do we divide the Fed's actions? So what has it done? What has it done to kind of provide that support? I would divide it into two groups. So the first is everything that the Fed can do without invoking emergency powers. So it's 13.3 emergency powers. What can it do without invoking those? Well, inject money, so print money and put it in the Fed funds market to drive the Fed funds rate down to 0. Print money and use it to buy long-term government bonds in order to lower term premia on those assets. What the goal is not so much to lower yields on long-term government assets. The goal is, well, maybe some of that will cascade out. Most likely it won't, given that there is some seizure in the markets, but you might as well try. That's sort of the first set of policies. The second, which is the much more targeted and kind of the ones that have much greater probability of actually helping out, are the ones that come from invoking 13.3. So here the Fed targets sort of specific parts of the economy. Let me kind of just open a parenthesis and maybe say a few words about what the Treasury's role in this is. So the financial press kind of reports on the $450 billion in the CARES Act that the Fed is going to lever up. So where that comes in is so the Fed cannot knowingly take on credit risk. So that's kind of like the loose way to say it. The formal way to say it is any emergency lending that it does has to be secured to its satisfaction. So the money that the Treasury is basically putting up is collateral to a lot of these emergency programs that the Fed is rolling out. The Fed would be able to set them up without that money as a backstop, but it would be much harder to get collateral that's secure to its satisfaction. So kind of that fiscal policy response did in fact grease the wheels a little bit and allow the Fed to move faster. So the types of programs that you're seeing, I mean, there's the programs that are for financial markets, for commercial paper, corporate bonds, municipal bonds, markets that are sort of like organs in the economy that you want to survive so that, you know, when we come out on the other side, they can regalvanize as quickly as possible. The next set of programs is going to be programs that are trying to incentivize banks to lend to parts of the economy that sort of most need it. So the idea would be that the Fed is going to lend to banks and accept as collateral the types of loans that, you know, the monetary and fiscal policy authorities deem to be the most essential to the economy. So an example that kind of came online today is the payroll protection program. So the Fed, I mean, this was announced a while ago, but today it came online and is ready to lend. So the Fed is basically going to lend to banks so that they can support firms through the Small Business Administration's program to support payrolls. The last set of programs, and the ones that I think are the most kind of creative and unconventional for the Fed, are the ones that are the Main Street lending programs. So these are ones where the Fed is just going to go straight to small and medium-sized businesses. The ones that are going to be most affected by this are face-to-face services, businesses that rely on foot traffic. I mean, they're effectively shut down. Now, this is different. So there are programs in place where the Fed will incentivize banks to lend to firms by making loans to the banks, but the banks still retain the exposure. The Main Street lending program, the Fed is going to take on 95% of the exposure. So the banks will still make the loan, but the Fed is the one that's taking on that exposure, and there is collateral from the Treasury so that the Fed is not knowingly taking on credit risk. But that's kind of, I think that's the one that economists are maybe the most excited about. It has the potential to very pointedly direct funding to the places that need it most acutely. The devil is in the implementation details, so we will see sort of how quickly it's able to get off the ground. But this is something that sort of signals the Fed is very aware of where money needs to go. So maybe let me sort of conclude with two things. The Fed's balance sheet is expanding very quickly. So it's since the beginning of the year, it's gone up by kind of on the order of $2 trillion. And that's sort of just the beginning. So it's going to get bigger as more of these 13.3 programs actually open up and become operational. So in some sense, there's a question of why do the amounts have to be so big? Again, it's the misperception is going to come from comparing to normal times. So in normal times, you have the benefit of something like the money multiplier. The Fed can provide a little bit of stimulus, and it's going to multiply as it works its way through the economy. We don't really have that luxury now. So it's kind of like the final amount of stimulus that you want in the economy, the Fed is going to have to provide it upfront. Now, to judge the success of that, you have to remember the goal. So the goal is not, at least as long as this public health response is in place of social distancing and shelter in place, the goal is not to have a fully functioning economy. Just like the goal of life support is not to have your patient run a marathon while they're on life support. What we're aiming for is kind of keeping the foundations, keeping things in place as much as possible so that when we remove the public health response, things can get back to normal more quickly. And I think that's sort of where success needs to be judged. So yes, we might have 20% unemployment while the Fed is expanding its balance sheet by trillions of dollars. But as long as we're in a medically induced coma, that's not telling you that the Fed has failed. I think that what you need to see is once the public health part of this is under control and we start to kind of relax those measures, how quickly do we go from 20 to 3? And I think if the Fed has sort of kept the relevant organs in the economy functioning, then it's going to be painful. To be clear, it's going to be painful and it's not going to be instantaneous, but success will be how quickly we get back to normal economic activity. Now, the last thing I will say is the Fed's job doesn't end there. So once once the medical part of this issue has been resolved, there's a massive cleanup for the Fed. So all of this liquidity that has been injected needs to be taken out, because that is not the liquidity you need in normal times. So as we begin to recover, the Fed has a massive cleanup job to do. So in some sense, their work is just beginning. You know, people are worried about inflation and all that, but I would echo Frank that the first order thing here is public health. Once we're talking about the details of inflation, that means we've succeeded. That means like the hardest part is over. And inflation is more or less a problem that we know how to deal with. So, you know, think of what the Fed is doing as life support, and it has a lot of work ahead of itself in terms of keeping the economy on life support to buy time for the medical community, and then sort of gradually taking the stuff out as we return to normal. So I will stop there and turn it over to Jonathan for the Q&A.
Oh, great. Kenda, Frank, thank you very much for the insightful remarks. And I want to welcome questions from all of the participants. I see some already coming through in our Q&A feature. If you have questions, please submit them through the Q&A feature on the Zoom chat. Some of the questions coming through are predictably about inflation. And you know, as we know, the dollar value of the monetary and fiscal stimulus so far has exceeded almost 6 trillion. And I think it raises questions about what impact this might have on inflation longer term in our country. And I thought maybe one or both of you might want to address that question.
Sure, I'll start since Kenda just mentioned it. I'll give her a chance to catch her breath. So Kenda got it right. I mean, of course, Kenda got it right, but at the very end, she said, you know, when we talk about inflation, that means that we've won, right? That the patient has survived, and then we have to manage. There's long-term risks with the policy response. There's going to be long-term risks. There'll be long-term risks on inflation. There'll be more pressing risks on companies that maybe should have gone under and have been propped up, right? And there'll be slippages in how the funds get allocated, all these sort of things. On inflation, I think that's the most benign of all the long-term risks, in that when we get there, we've succeeded, right? The patient has survived, and now we're starting to have problems from too much liquidity, too much demand, and inflation goes up. As Kenda pointed out, these are problems we know how to deal with. The Fed knows how to deal with. Central banks are pretty good at dealing with this if they choose to. When they failed in the past, it's been a choice. It's been a deliberate choice to turn their head the other way when inflation has popped up. So that would be a good thing. So that would be something that I would urge you not to worry about yet. If you think about the reduction in GDP growth, and if you think that slack resources have anything to do with inflation dynamics, impact inflation dynamics in any way, we're going to have enormous amount of slack in the global economy for well over a year, if not 2 years. That's going to keep a lid on inflation. The inflation that you'd have to get, I think, will come from disrupted supply chains. And so as everybody starts to rethink the supply chains and the concentration risk in their supply chains, that could lead to higher costs. That certainly could. And so that's something to keep an eye on. But from the Fed's response, from the fiscal response, if we get inflation, that's a good thing.
Yeah, so I mean, I agree with Frank agreeing with me. He fleshed it out, I think, perfectly. So there's really not much that I can add, except that if that is your concern, like if inflation becomes a concern, the Fed can pull the money out. There is nothing that prevents it from doing that. Now, there are choices that have to be made. So, you know, the rate at which you pull things out. So let's say something like the Main Street Lending Program, that's a bit new. I mean, so that's kind of like the Fed is directly exposed or is taking on exposure from small businesses. How do you pull money out of their hands? That would probably be the last facility that you would unwind. But all of the things related to financial markets, I mean, these are facilities that were set up during the crisis and they were unwound after the crisis. So the Fed has experience in doing this. I think central banks around the world have experience in doing it. So yes, we might see a little bit of inflation, but the moment it becomes an issue, contractionary policy is very easy to pursue.
That's really helpful. I think so many of us have been focused on the impact on the markets, and you look at what the Fed has done to ease the liquidity crunch, and you look specifically at either market returns or high yield spreads or corporate spreads, and they've improved dramatically in the last few weeks. I think it'd be important to talk about what would be primary indicators that you'd want to look for to kind of give you the sense that we're getting back to normal. How would the Fed, how would you look to kind of begin to feel like things are normalizing? What would be those indicators?
So I think in some sense, I don't know that we could ever think of normal while we still live in a world with shelter in place orders and social distancing. I think it's a new world. I mean, I don't know that we've ever, at least in my lifetime, I've not lived through something that looks like this. So I don't know what the right benchmark there would be. It's really going to be once the economy opens up again, the Fed sort of pulling out of some of these markets, how gradually does it need to pull out? If it needs to go super slowly, we're not there yet. So, I mean, if it starts selling off some of its assets and you see a massive spike, then we're definitely not there yet. One indicator that I think, at least for me at the very beginning, was useful from a bank perspective was the facilities that the Fed set up for repo markets. So basically to inject liquidity into repo markets, it was in some sense undersubscribed. Now, part of that is, to use Frank's term, by design. I mean, the Fed kind of is able to provide more liquidity, but it also sort of shows that, at least in the banking sector, there's a finite demand for liquidity. So it's not that there's this like massive shortage in the financial system. And I think, to me, that was useful. So once you start to see take-up rates slow down a little bit, as the public health response becomes as we're able to gradually reopen, I think that combination, that take-up rates go down as we begin to reopen the economy. But I honestly don't think that normal is going to be a term we can really talk about until, at the risk of sort of repeating what the doctors always say, but until we have massive capacity for testing and until those tests are quick and accurate. I think once we have those, then we can start to say, all right, let's look at credit spreads. Let's look at all these usual things. In some sense, the numbers that we see now are a little bit by construction.
So I'll pick up on what Kinda said. So the early indicators are all going to be on the health side, on the public health side, right? So don't think about indicators, in financial markets or employment numbers, things like that. It has to be on the public health side first, right? And with widespread, accurate testing, do we start to see numbers going down? That should be the leading indicator, something like that. If you think about the spreads that Jonathan mentioned, that we all look at, these are, when they widen dramatically, these are signals of particular markets not working. So Kinda mentioned the repo market, commercial paper market. I mean, different markets, particular markets not functioning properly, and therefore the funding that they support being impaired. And that's exactly what the Fed is looking at. And when they see that, they step in, and as Jonathan said, a lot of those spreads have come back a bit, but they're monitoring exactly that, right? And across many markets. So I would say the leading indicator will be on the public health side, not it won't be the normal things that we look at. And the normal things that we look at will suggest if certain markets are seizing up, and that's exactly what a lot of the Fed facilities are lined up to do. Back to you, Jonathan. Yep.
Frank, Kenda, the balance sheet of the Fed has grown tremendously, and if we were to see a second wave of this virus pop up, I think the Fed's said that they're willing to do more if needed. Is there any limit to what the Fed can do? Is there a limit to the size of the Fed's balance sheet? Are there any legalities around caps to their ability to respond to something like this?
So the short answer is no. I think that the kind of constraint, if you want to call it a constraint, is everything that it does under its 13.3 authority has to be secured to its satisfaction. As long as it has that, there's no limit. I mean, so the Fed is not borrowing, the Fed is printing money and injecting into these programs. So, if we do get a second wave, I mean, there's some debate about what is this going to be? Are they going to buy equities? Maybe they buy equities if they judge that that's kind of the sector of the economy that really needs to be propped up. But you could also imagine a scenario where they realize that they need to expand the Main Street business lending program. If I think they've said that they're going to lend up to $600 billion, but suppose that thing gets oversubscribed, then you need to do more of that. I think there was one question in the chat about sort of commenting again on the Treasury's role in this. So again, to the point of the Fed cannot open one of these 13.3 facilities expecting that it might take a loss. It's just in the Fed Act, that is the constraint that is put on the Fed. So what you would need to do is have adequate collateral. It's possible that some of these smaller businesses are not going to be able to post kind of what would be deemed adequate collateral. So the Treasury allocating a subset of funds that could absorb a first wave of losses effectively makes kind of the Fed a bit more senior in this arrangement. Now, who's ultimately going to bear the loss if there's a loss? Well, keep in mind that there are many programs going on at the same time. So just like in the response to the financial crisis, the mortgage relief programs took a loss. I mean, that was by design, but the Treasury made money on lending programs to banks and it's lending to AIG. So at the end, you kind of have to take the net response and see what's left over. So maybe we do wipe through all of the Treasury's collateral, and if no other program has made a gain, the taxpayer has to deal with that. I mean, that's kind of how fiscal policy works. But there are other things that the Treasury is lending to that it may make money on, in which case it's a wash. So again, the short answer to the question of what are the constraints on the Fed, there's no constraint on how expansionary it can be. Once you invoke your 13.3, as long as you deem that things are adequately collateralized, they can go for it. And the Treasury has been helpful in this regard in terms of making sure that the Fed doesn't get hung up on kind of like the legalities of what is adequate collateral. So providing some of that support to backstop these facilities really does allow the Fed to get the term sheets out quickly.
I'll agree and add that Kid is absolutely right. There is no limit, but then the limit is actually now through Treasury, right? So one of the changes after the GFC is that the Fed cannot unilaterally go into some of this stuff that's risky, that's inherently risky, and just say, well, it's a crisis, we need to do it. So that part of their 13.3 powers was stripped away after the GFC. And so Treasury does have to sign off on this, does have to be helpful and supportive. And if they choose not to, then that would put a limit on some of the programs, not all of the programs, but some of the programs. So there's no limit, let's say, but after the GFC, so Treasury does have to sign off on some of this stuff. I'll mention another thing, that it's as we stress repeatedly, it's a public health issue. It's a public health issue, as Kinda mentioned earlier, that the cost of which is greater than any one of us will actually feel, right? And so that requires a public response, and that's what public balance sheets are for. That's what government balance sheets are for, to actually fund things like this. And it could end up being costly in terms of the dollar and the dollar amount and the debt. But if you think that the outcome that we're looking for is a good public health outcome, then this is exactly what government balance sheets are for. And so that's another aspect of this. It's mostly going to be a fiscal response, right? We're talking about the Fed today, but most of this is going to be a fiscal response. Even the Main Street lending mechanism that the Fed has, I think about as a fiscal response. It's just that the Fed is the best one to get the money to the banks. And so they're sort of acting on behalf of Treasury, in my mind, on that particular program. It's really a fiscal response to get money to businesses, get money to households, support people through this to get the public health outcome that you want. In that world, debt levels are going to skyrocket. Public debt levels are just going to skyrocket all around the world, US included. And that's something, if you think about the things that we're going to have to deal with after we get through this, that's certainly one, right? So we were in a high public debt world going into this, and we've supercharged that.
Yeah. Frank, you just mentioned the great financial crisis. And during that period of time, the Fed employed some new policies and learned a lot in the process of helping our economy recover during the GFC. What do you anticipate to be lessons learned during this crisis that might become part of the new normal or part of the arsenal of the Fed going forward as years and decades to come, we have more of these crises to fight?
I'll start, and then Kinda, you can jump in because you're more of an expert on these things than I am. So I think part of the lessons that the Fed, as Kinda said, a lot of these things, a lot of these programs that seem confusing, maybe they set up during the GFC for the response to the GFC. Not all of them, so some of them are new, but some of them they've set up before. Fine, they know how they worked, and they understand how to have targeted programs for different, let's say, lending facilities. I think of it that way. But one thing that they're going to take away from this that they had already learned is we used to think of monetary policy as a very, very blunt tool. And if we're just thinking about the level of the Fed funds rate and things like that, then it is a blunt tool. It applies to everybody. But through last year, through their Fed Listens tour, and this is in part because of the renewed recognition that inequality is a big deal. So the Fed went around and listened to communities that they had not previously interacted much with. They got a newfound understanding and appreciation of the distribution of incomes and outcomes in our economy. That, I think, is guiding some of their thinking right now. So the Main Street lending program, realizing that for the public health response, we need to get money to the small businesses. I think that might have come out of this Fed Listen. So this broader appreciation for the distribution, for inequality issues, I think that is something that is really going to stick with the Fed. They're going to come out. It's supposed to be this summer. Who knows if it's going to be delayed? But they'll come out with their renewed thinking on monetary policy in general, and I think this will be a feature. Kinda, did you have additional thoughts on this?
No, I think that's right. I mean, the programs that the Fed was able to roll out the most quickly are the ones that it had actually worked on during the financial crisis. So the commercial paper lending facility, that was something that they did there. The TALF, that was something that they did there. So those ones, like, they announced extremely quickly using sort of the pricing. So they have a baseline way to price these things based on the calculations they did in the crisis. So I think the one that's really new is the Main Street one. I mean, the fact that the Fed is going to take on 95% of the exposure is something that, I mean, is not, the Fed doesn't do that. So that's kind of new and innovative. It's also difficult to price. But I think to Frank's point, this idea that the Fed funds rate is I think it creates confusion about once it's zero, the Fed has no more ammunition. That's not true. That's an artifact of sort of using the Fed funds rate as a synonym for Fed action in normal times. But that's just one interest rate. I mean, what you ultimately care about is the interest rates that businesses face, some of which are priced in markets, some of which are kind of, there's a shadow price because loans to small businesses, unless they're securitized, are not publicly traded or are not traded in financial markets. So as long as the Fed has its 13.3 powers, and as long as there is sort of support from the Treasury, which in both cases there was, so in the GFC in 2008 and currently, in some sense, I don't know that if you were governor of the Fed, you could really ask for more from the Treasury Secretary in terms of the support that, the willingness to provide support at this point. As long as that's in place, monetary policy can actually get in to little corners of the economy. And now there's a question of, is that going to be our new normal? So is it possible we come to a world where, well, it might actually be nice if you have monetary policy targeting specific corners of the economy? And so that's probably a debate that's going to be had. But I mean, they can do it. They've been doing it. I think pricing on the Main Street facility will kind of complete the arsenal, so to speak, for future crises, because now they're going to have baseline term sheets for both financial markets and things that they lend directly to.
And then Frank, you've both mentioned the importance of the fiscal response. How coordinated is the Fed trying to be throughout this time in its response with the fiscal response in Congress? Could you comment on that?
Sure. So I think, so I view, so if we had this session 3 or 4 weeks ago, many of the questions would be, can you believe that the Fed dropped the Fed funds rate 50 basis points this day or 100 basis points this day? It'd be all about that as the fiscal response was being debated, let's say. But now, on April 16th, we can say that the monetary policy, the traditional monetary policy response is of third order, let's say, importance. It's just not that important. It's really, this is all about fiscal. And there's some things that on the fiscal side, the Fed can actually do more efficiently. So the Main Street lending, so anything that goes through banks, the Fed is probably more efficient at getting the money to the banks and leaning on the banks to lend it to entities. They're probably more efficient at doing that than the fiscal authorities would be. And so, but I still view it as a fiscal response. So I think that they're very coordinated on this, probably the most coordinated that they've been in years. Everybody agrees that, everybody still seems to agree that the public health response needs to be to shut down parts of the economy. That's going to create a cash flow crisis. Let's see where those cash flow crises are, and let's try to plug them. Let's try to help out. Let's try not to allow any entity that should be ongoing to actually default or go out of business because of this crisis, right? So let's try to buy time, right? Buy time for the public health system, buy time for entities that have to shut down their operations, buy time so that they don't actually have to go out of business, that they can start back up. And that's, to me, so they're very coordinated, and it really is on the fiscal side more than the monetary policy side. For the Fed, as Ken laid out before, a lot of their activities is much more about freeing up markets, right? Just to make sure that things still flow. You don't want entities going out of business because of this crisis. You want to be able to, you just want to buy some time, I think.
Frank, you've done a lot of work around with emerging markets and studying that space. So a number of questions have come through specific to emerging markets, and I wonder if maybe we could spend a few minutes just discussing what you see as the impact of this coronavirus pandemic and the economic consequences on emerging markets, and then tying it back to the Fed. If ultimately the Fed is successful in helping to bring back our economy, what will those impacts be on a rebounding U.S. economy on emerging markets?
Yeah, okay. So I happy to talk about that. I did notice in the chat, and this is related. I did notice in the chat a question that some countries have, let's say, a much stronger public health system than we do in the U.S. And a stronger maybe stronger social safety net, right? So I think that was the exact wording. So do we expect those countries to rebound faster, right, to get through this better than the U.S.? On that, I would say that the world is interconnected, right? So if you think, for example, so Canada, so Kinda's up in Toronto now. Canada has a much more of a focus on what I would call inclusive growth, right, and the safety net than the U.S. does. Does that mean that the Canadian economy is going to necessarily get through this better? Canadian economy, one, is very tied to the U.S. economy, so we will drag them down. And two, it's very tied to commodity markets. As a commodity exporter, and as global growth falls, Canadian economy will be dragged down as well. So it's a little bit more complicated than just looking at the social safety net. The partial effect, I think you're right, would be that those countries should be better off, but there's a lot of other things going on. That's one. Two, from the emerging market perspective, there's two ways of thinking about this. One is classic GEM three-pane model, a CF shock, a capital outflow shock, right? So as this crisis hit, money flows into safe assets. If you think internationally, what's a safe assets? U.S. Treasury bonds. So a lot of money flowing into U.S. dollars. U.S. dollar goes up. It has been appreciating. Emerging market currencies will fall. Those who have borrowed in dollars, and that has occurred to a lesser extent, but some of them have still borrowed a lot in dollars, they're going to have a tough time. And so that's one shock. If they weren't fragile going into this, the depreciation will actually be helpful. So the partial effect will be that it will help them get out of this. But if they're fragile, so if they need to borrow, right? So we have a hole now in core GEM or BPE for those of you who go back far enough. We have a whole different sessions on fragilities and economies. And to think about fragilities in economies, it just comes down to, if you start with, I need to borrow, right? So I need to borrow, and every period I need to borrow, that's fragile because you don't know what the market conditions are going to be, as opposed to choosing to borrow to expand production, expand your human capital, et cetera, et cetera. Countries that were fragile going into this are going to have a really tough time getting through it. That's two. Three, the decline in demand for commodities is going to hit a lot of emerging markets hard. So they're going to have that. Many of them are commodity producers. They're going to have a declined demand for their goods. Those that were fragile are going to have a tough time, and they're going to have the same sort of tough time that they usually have when the dollar appreciates. So that'll be difficult. There's already a lot of IMF, World Bank programs to try to help out, but it'll be tough times.
So maybe let me add a few things to that. So just, since I am in Canada, let me kind of speak to Canada. I think that the issue with this virus is that it really doesn't discriminate. Hospitals in Canada, which I would think a country like Canada has, in terms of medical supplies per capita, I think coming into this was in a good position. But I mean, just how quickly this thing spreads, there's shortages. So shortages in PPE do not discriminate. I mean, hospitals in Ontario are essentially asking the public for help, for donations of these supplies. And now anyone that has a 3D printer is printing sort of the visors. So, a social safety net helps, but when you have something that is so contagious, you very quickly find yourself in the part of the curve where we've all hit our constraints. So it buys time for sure. And, but what you do with that time is really what matters. So, that's kind of point number one in terms of differences in safety nets. If you seize it from the beginning, that'll buy you a lot. But if you think that you can rely on your safety net and you can rely on kind of supplies that you stocked up, you're going to get depleted very quickly. I mean, the spread of this thing is massive. On emerging markets, so the one thing I will comment on is, and I think the question has come up in the chat, the swap lines between the Fed and other central banks. So this was something that the Fed started during the financial crisis. The idea was to be able to provide dollar liquidity, not necessarily to other central banks per se, but to agents in the countries that are sort of related or that those central banks operate in. That's been extended. So the Fed kind of did its usual central bank swap lines with the Bank of England, Bank of Japan, et cetera. And there's a new program that came in that effectively does a similar thing for a broader range of central banks. Now, if you look at it from a purely US perspective, the idea would be that you don't really want international investors dumping US government bonds in order to get US dollars, because that's going to cause turmoil in those markets. So willingness to tons of contracts are denominated in US dollars. I mean, it is a reserve currency. The demand for the US dollar is extremely strong. And so by providing those swap lines, I think the Fed protects financial markets domestically, and that you don't get a dumping of US assets in order to get pure cash. And that's useful because you don't want the financial markets to seize up after everything the Fed has been doing in order to keep them operational. But it also does give those economies the dollars that they need. The last consideration I'll bring up is going forward. I mean, I think there are some questions in the chat about what are the long-term implications of all of this. Our finance colleagues always talk about diversification. I mean, as economists, we talk about specialization and gains from trade. Our finance colleagues talk about having a diversified portfolio. I mean, at the very least, I anticipate that there's going to be demand for more diversified suppliers. Being reliant on one particular country for a vast majority of your pharmaceuticals or your medical equipment is dangerous. I mean, finance tells you that you're not diversified, and if there's a shock there, you're in trouble. So I think you might begin to see, as we come out of this, more of a move towards the finance way of thinking, a little bit less like moving away from this idea of specialization, more towards diversification. That matters for emerging markets. That matters for countries that have typically supplied goods. So there's going to be changes that may play out on that dimension. And perhaps the markets that can most quickly adapt to that are the ones that will most survive.
Now, just to add to that, so one way to think about it is there was an underappreciation of certain risks leading up to the GFC, right? And so counterparty risk, different risks in the financial system. Leading into this particular crisis, there was an underappreciation of concentration risk, right, in supply chains and in many other things. And I think that is being rethought and will be rethought after we get out of this.
Frank and Kinda, we've talked a lot about the different policies that the Fed has enacted, and we spoke earlier about the zero interest rate policy, and they quickly dropped rates to zero. Would you anticipate any scenario in which the Fed would look to perhaps move rates negative, as we see in other central banks?
Who wants to take this, Kinda?
So I can start. I think the question is for what purpose? Ultimately, the interest rates that you care about, so let's say work under the assumption that small and medium-sized businesses are the ones that are going to bear a lot of the economic costs. They don't borrow at a market-determined rate per se. So when we think about the interest rates that the long-term interest rates that they face, I mean, it's not that this is publicly traded, but you could still apply the same sorts of equations to that, which is, all right, long-term rates are an average of current and expected future short-term rates plus a term premium. One way to lower those rates is to go extremely negative on the short end so that that cascades through the long. The other is to just directly flood money into those markets so that you lower the term premium. It's not clear though. So now if you go negative, that introduces a whole new set of risks because cash is always an option. And you worry that, I think, if you try to estimate how negative you would have to go in order to provide the same amount of stimulus that kind of monetary injections have been providing, I'm going to ballpark it at maybe negative 10%. I mean, and that's unheard of. So if you go down that road, I mean, sure, go negative 1%. I don't think it's going to make a difference. But at the end, again, it's sort of people get fixated on, oh, the Fed funds rate is at 0, that means we're constrained. And it's like, well, no, look at the spectrum of interest rates. As long as there are some long-term interest rates that are not 0, the Fed has room to act without going negative on the short end. The Fed just goes into those longer-term markets and supplies the liquidity to decrease the term premium. So at this juncture, they may, I mean, anything's possible, but from an economics perspective, there is no reason why that would be preferable to just directly providing money in long-term markets. In fact, it could be detrimental.
And so I fully agree. And I think the Fed's thinking on this is just negative Fed funds rate is a step into the unknown. And there's negative rates in a lot of countries around the world, and none of those countries can say that the policymakers in those countries can't say that they're particularly happy with the outcomes. And so it's a step into the unknown, and there's not a lot of examples out there that this has been truly, truly successful. And so prudence would say, why bother, right? So when we have so many other facilities, so many other ways of getting at this, why would we do that? So I doubt that they would go negative. It doesn't mean that they won't. And Kinda's right that there's just there's better tools for what they're trying to do. Another way of putting it is, this isn't about the response. A proper response to this situation is not about the cost of capital, right? There is nobody out there that's saying, I won't borrow at 1%, but oh, at 0% I might borrow. That's just not going on, right? I mean, so it's not about the cost of capital per se. And so it's really not a traditional monetary policy response that's needed. It's much more on the, first and foremost, on the public health side and the health system side, and allowing them to do their jobs. And then it's a fiscal response. And then alongside the fiscal response, all the Fed facilities to make sure markets don't seize up. And then at the end of all this list comes traditional monetary policy, but that's it's not the primary response to this sort of crisis.
This has been a wonderful conversation, and kind of going back to the start of it, and Kinda kind of comparing the Fed's response to putting a patient on life support. And what the Fed has done has been remarkable, and has certainly eased the liquidity crunch in our country. And if you look at jobless claim numbers that came out today, they are improving. The numbers are horrible. 5.5 million new unemployed, and now we're nearly 22 million in the last 4 weeks. But the numbers are getting better. It was over 6 last week. So I guess we can try to be hopeful that the response of the Fed and the fiscal response is starting to have an impact, and it's starting to kind of bend the curve a bit. And I really thank you, Frank, and thank you, Kinda, for your time and for sharing your insights and thoughts into the monetary policy and Federal Reserve's actions here over the last few weeks. And I want to thank everybody for participating, your wonderful questions. And I want to invite you each to join future sessions with Darden faculty. There will be links posted in the chat box, and I wish everyone a wonderful day and be well.